Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course enough to make it actionable, understandable, and clear. What a week. Woo! Spring break too, and what a show. We came back to record, guys. We came back. We're here in Dallas. Spend a little time on the West Coast, making sure index funds still work over there. They do. But we've got three important items to discuss. A little bit of choppiness in the market you may have noticed. Hopefully you didn't. Hopefully you didn't notice at all because you're just so disinterested in volatility. But we're going to look at something Mr. Peter Mallouk put out on the X app that I think was really helpful. We're also going to look at an article by Crystal Herr about the mounting case against U.S. stocks. Get ready for the news cycle to turn against U.S. stocks. Whew, it's been a rough week for that. And then we look at a retirement savings weapon that I think hardly ever gets discussed, and I never talk about it. So I had to educate myself further on these cash balance plans. Ann Tergeson put out an interesting article that piqued my curiosity. It should pique yours as well because it talks about a local Dallas practice in it. So at the top, Mr. Mallouk, one of our favorites, he mentions this. He says the S&P 500 is down over 8% from its February closing high. Over the last 75 years, the average intra-year market drop has been close to 14%. Now, let me explain that. When it says the average intra-year market drop, that means top to bottom in any given year, the market will travel down 14%. That doesn't mean it ends that way. And many of these 14% drawdowns, wouldn't you know it, the market can be up in that particular year or flat. So what Mr. Mallouk does is he then gives examples from 1950 to present, hence the 75 years, and he talks about the drawdowns and the total return that year. And boy, did I think it was interesting. So if we're down, and Mr. Mallouk said this a couple days ago, so the market's been moving so much, it's probably not super fresh. But he says, the S&P 500 down 8%. My experience is you kind of feel that, don't you? You kind of feel that. Down 8% from February closing high. Year to date, it's only down a little less than 6%. But let's go back down memory lane. I want to read some years to you about this intra-year market drop and then what the actual return was that year. 1950. Do I have any listeners? Any listeners that were active in the market in 1950? I think I might. Your drawdown was 14%. You know what your return was? You're up 30.8%. Wow. 1951. Your drawdown, max drawdown, 8.1%. You're up 23.7%. And on and on and on and on. Let me find an example where you'd say, oh, yeah, no bueno. Let's go to, this is a great one. 1987. The drawdown was 33.5%. You're still up 5.8% in that year. Now, 1981, drawdown was 18.4%. You were down 4.7%. 1974, this is rough. You were down, drawdown 37.6%. The actual return for the year was 25.9%. Okay, so does that make sense, class, what we're doing here? In any given stock market year, there's a lot of ups and downs. If you measure and this is January to December. So if you measure the amount it goes down in the year, that's that drawdown figure I'm giving you. But the total return, that January to December figure, that's that second figure I'm giving you. So drawdown. Let's pick a year you guys remember. 2008. Remember that year? The drawdown top to in the year was 48.8% down. Total return that year down 37%. Ouch. 2009. Did you know 2009 you were up 26.5% January to December, but your drawdown that year, max drawdown, was down 27.6%. So I think you understand the point. To 2025, we don't know the answer yet, right? We're starting in January, we'll end in December and understand our return. Our drawdown is already down 8.6% top to bottom in the year. Do you know 2024 what the drawdown was top to bottom in the year? down 8.5%. You want to know what the S&P 500 return was for 2024? Up 25%. Let's go back one more year, 2023. Did you know that the drawdown top to bottom in that year, max, was down 10.3%? Guess what the total return in 2023 was? Up 26.3%. So what you're telling me is I shouldn't anchor too much to this short-term drawdown in the year, because what it can make you do is go a little crazy. You can begin to convince yourself that the sky is indeed falling. And it's always a possibility this is the one. You may start to hear that language. This is the one I've been waiting for. There's somebody that went to cash in 1978 and never got out of it. And they're still waiting for the one. Get ready. And these people become more and more popular the more there's volatility and the more the market goes down. These folks will come out of the woodwork and tell you, I seen it coming. I was waiting for it. I could sense the change in the wind. My bones were creaking. I knew the market was going down. Pay it no mind. Pay it no mind. Go be a data-driven investor and look at this drawdown language that Mr. Maluk gave. And boy, howdy. The average drawdown from 1950 to 1920 to 1950 from 1950 to 2024, average drawdown were down 13.6%. The average return was up 11.6%. So what that's going to tell you is you're going to have stuff like this happen where it feels like the world's ending, and those that typically do well are the ones that just don't care. They engage in what I call ostrich investing. The head goes in the sand and nothing else. So stick with it. Great data there by Mr. Maluk. Wall Street Journal article by Crystal Herr, headlined "The Mounting Case Against U.S. Stocks." And I have to chuckle just a bit because it wasn't but a few months prior where all you heard about was it's U.S. stocks forever. The news cycle was just preaching the importance of U.S. stocks and U.S. stocks alone, that American dynamism, it's irreplaceable, no one can replicate it, there's something special. Of course, I think there is too, but hyperbole was being used. And here we go, swinging back the other way. Subheadline: worries about a trade war, signs of flagging growth, and splinters in the AI trade are pressuring U.S. shares. A new round of recession fears rattled markets, the article explains. Monday, sending the Dow Jones Industrial Average down 900 points. That never means anything to me. Percentage data is the only thing that matters. Down 900 points, whatever. Wall Street consensus that U.S. stocks will be among this year's biggest winners. It erodes Wall Street consensus, okay? So Wall Street thought the U.S. stocks would be big winners. Who knows? What are people worried about? You ready? The article explains worries about a trade war. Signs of flagging growth and splinters in the AI trade have taken some of the shine off that optimism. President Trump, over the weekend, refused to rule out a recession this year. Okay. I mean, he doesn't have that kind of power, but he can do the tariffs. S&P 500's down. NASDAQ is down more. Banks led. Now, here's Shelby McFadden tells us, and this is trying to stir up some fears in you. You ready? This is the first time we've had an administration pretty much say with a straight face, the objectives are going to cause pain. I kind of doubt that. I recall Mr. Harry Truman always giving people a hard time, and then them asking, Mr. Truman, why are you so tough with us? Why do you give us such a tough word every time you stop? He said, well, I don't give them heck. I tell them the truth, and they think it's heck. That's what he says. I edit it for our younger listeners. So I have a feeling previous administrations have given tough talk like that before. But here we go. The news cycle is telling you previous administrations have never done this before. So I do think there's something real to this tariff business and this, as they call it, inflammatory policy promises that Trump's doing. So anytime you read this in the headline, what's happening? And let's just talk about what's happening. When the stock market goes down, what's occurring? We have more sellers than buyers in that moment. And so price equilibrium, that's what the market does. That's its function. It's seeking a price where it can match buyers and sellers. Because guess what? For every buyer, there's a seller. So when there's more people that want to sell, you have to find buyers. You know how you find buyers? You lower the price. It's really pretty simple and kind of brilliant. So if we didn't have actual money in the market, we may just look back and be in awe of the efficiency of this mechanism. So much better than it was in the past. but it's just looking for buyers. So if there are sellers who are nervous, they actually feel their future cash flows will be less because tariffs. Hey, guess what? As Warren Buffett said, I think he said like the tooth fairy doesn't pay the tariff or something. He was trying to make a point that tariffs are paid by someone, usually the consumer, but ultimately sometimes companies have to bear that cost if the consumer's unwilling. Well, guess what? That could potentially hurt earnings. So maybe these investors were right to sell. I don't know. We'll find out. They're also saying that the AI trade, I talked about this last week, NVIDIA, this article explains, has lost more than $1 trillion of market cap since its peak in January. The Magnificent Seven tech stocks, Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla, are lower for the year, except for Meta. That's right. We don't know what's happening with interest rates. Goodness me. Will they get lowered? So Goldman Sachs, if you want to be scared even more, they predicts that per share earnings among companies in the S&P 500 could drop by roughly 1% to 2% for every 5 percentage point increase in the U.S. tariff rate. You see that? So you see the rationale for many investors? They're thinking, I was hopeful that earnings would be X when you include tariffs, and if the tariff war occurs for a long time, the earnings will be less. But we don't know how long that'll be. We don't know how long that will last. But let me tell you what not to do, because here's the news cycle. Here we go. In 2024, the S&P 500 outperformed the global index, the world index outside the U.S. Remember these international stocks that were just terrible? Oh dear, what's happening now? Germany's DAX index and France's index are up 14 and 9% respectively, smoking the U.S. performance. Hong Kong's up 19%. South Korea's up 7%. All these international stocks that we were told never to touch. They were poison. Wouldn't you know it? Here they go. The answer, investor, is not to play the news cycle game. No surprise for me. It's to just ensure that you have adequate exposure to various asset classes. It can be pretty simple. Ticker symbol VT is what I like. It's an exchange traded fund Vanguard has. It's a global ETF. You don't have to think about whether your international's up or your domestic's up. It's just everything. It's total world market. So I would say prepare yourself for the news cycle to switch pretty hard on U.S. stocks and make you feel silly for holding them. Don't pay them any mind at all. This too shall pass. And as Mr. Maluk reminded us, this could just be a little intra-year drop before a 25% return. We don't know. That's what happened last year. I don't know what's going to happen this year. No one else does either. And then in closing, you learn something new every day. Headline, the retirement savings weapon doctors and lawyers use to build wealth. I thought this was cool because they talk about Texas Oncology, which is a strong presence here in the North Texas area. But you've heard about 401k plans. That's a traditional means by which employees are able to put away money and their employers can contribute as well. But some companies will also have something called a cash balance plan. I was not very familiar with this. So I read this article, and it talks about this, I believe it's a radiation oncologist. He convinced Texas Oncology to start a cash balance plan in 2019. So maybe that's why I just haven't seen it a lot or heard about it a lot, they're just kind of catching on. But this article explains they've been around. They're just grown in popularity. The government opened up, made it a little easier for folks to administer. But you can put away a lot more money than a 401k. It's really... You may be familiar with the way a pension works. And typically, it's a defined benefit pension. These is really gone the way of the dodo bird, but historically, this was all that existed. You paid into your pension, and this pension plan usually had an income stream that you were promised after they have a little actuarial table, so many years of service and contribution, and here you go. You get an income stream. Well, this is a little bit of a hybrid figure that you can contribute a certain amount of money, and it's based on age and earnings and how the plan is administered. There's some complexities there. But oftentimes that number can be well above the 401k maximum contribution. So much so that in some of these plans, the article explains older, so you got to be older, higher earners can put away as much as $380,000 a year. Yeah, pick yourself up off the floor. Younger and lower paid people have lower limits. Wow. Now, this is the company gets a tax deduction for contributing to this. The employee doesn't pay taxes on it, and it's like a 401k in that you can elect, and this is what typically happens. People will, at the end of their employment, will actually roll these into IRAs, and there'll be some sort of a defined return. But boy, howdy, this article taught me enough for at least if you're an employee and you feel like, and it's rare, I know, but if you've contributed, you've maxed out your 401k, and you're a high earner, and you've got more bandwidth, and you think this is something your employer will be up for, or they already have, ask about a cash balance plan. If you're a business owner, it may be wise. I've never done this, but I probably will research it. Figure out how difficult is it for someone to administer this for me, because you can really put away a lot of money, shield it from the government, and then you're able to roll it into an IRA. This article explains that in '96, Congress gave these plans a boost by eliminating some of the restrictions they had. There was a combined limit on the 401k and pension, and then after a 2006 law removed uncertainty about legality, they really are starting to come around, and more people are looking at these. So some of the highlights, this article explains that it's a lot of doctors and lawyers, high-earning folks who can put a lot away. There was a gentleman, part of Camino Medical Group in Mountain View, California. They added a cash balance plan in 2000, and he said his colleagues ultimately, they terminated the cash balance plan, started a new one, but they got to roll over their old amounts that this group had funneled money into, and people were just ecstatic because they got all this money into their 401k. The employer pays a little more, but they get to retain talent and get a tax deduction. So this is a cursory overview, but it made me think, I need to know about these cash balance plans, and we should all be asking. If you're at an employer and they don't have a cash balance plan, or they do, you need to ask about it. Ask HR and say, do you have a cash balance plan? Because the benefits are large enough, it's going to be worth the hassle factor. Now, let's say you don't have a cash balance plan. I still don't think it's that big a deal. So if I'm going to take devil's advocate here, I'd say you have something called the taxable brokerage account, which in my view is one of the greatest accounts for retirement if you have this adequate self-control for it, because you can tax loss harvest. I mean, you can sell securities lower than you bought them for and repurchase similar securities, not identical, similar securities, and you get access to the money if you need it. You can borrow against it. Again, you got to have that self-control, but don't fret if you don't have access to this. You can save in a beautiful, wonderful taxable brokerage account without required minimum distributions and without the money coming out at ordinary income tax rates, because the brokerage account, you're going to be able to sell it and capital gains and dividends, the rest. So much there, much more to learn. Don't fret about this volatility. I'll tell you what to fret about. Fret about keeping your cost low, investing simple, and time horizon long, because that's what's going to give you the best shot on your investing journey. Until next week.